All right, welcome to Iron Financial. This is the place where we help you forge a stronger portfolio and cut right through all that market weakness. Today, we're putting Sally Beauty Holdings, that's ticker SBH, we're putting it under the microscope. They just dropped their Q1 numbers and, the headline looks pretty solid. But the market's reaction was, well, it was anything but. So we're going to tear this report apart, piece by piece, and figure out if this company is built on solid bedrock, or if there are some serious foundational cracks that could bring the whole structure tumbling down. Let's get to work. Okay, let's just dive right into the numbers here. On the surface, this was a clean beat, no question about it. Revenue came in at $943 million, just squeaking by the $940 consensus. But more importantly, adjusted earnings per share, or EPS, hit 48 cents. That's a solid beat over the 46 cents Wall Street was looking for. Look, in a market like this, a double beat, that's supposed to be a home run. It's the kind of report that should build confidence, a signal that management has a firm grip on the wheel. But that's just not what happened. The immediate reaction from the market was a drop of nearly 9%. That's not a little wobble, that's a flinch, a big one. And that's the billion-dollar question, isn't it? If the numbers look so good on paper, why did the so-called smart money run for the exits? This is exactly where we have to look past the polished press release and really dig into the guts of the company's performance. The market isn't reacting to the headline beat, it's reacting to what's buried in the fine print. It's smelling something just below the surface that suggests maybe, just maybe, that foundation isn't quite as solid as the headline wants you to believe. So is this all hype, or is it real? Let's find out. Exactly. And look, before we start knocking down walls and looking for cracks, you have to respect the architecture. You just don't dismiss a company that's clearly executing its plan. So let's start by building the bull case. I'm going to lay out the hard numbers, the structural supports that management is pointing to as solid evidence of strength and durability. These are the facts on the page, the core metrics that, in a vacuum, tell a pretty compelling story of a well-managed company that's navigating a really tough environment. Now, what's really interesting here isn't just the beat itself, it's the consistency. Look at that adjusted EPS number, a 3.4% surprise to the upside. Nice. But this isn't some flash in the pan. This marks the 6th consecutive quarter that Sally Beauty has either met or beaten earnings estimates. 6 quarters in a row. That's a year and a half of delivering. That is not luck. That is disciplined execution. It shows you have a management team that knows how to manage costs, how to control their margins, and how to deliver profitability. Even when the top-line revenue isn't exactly screaming higher, they are consistently doing what they promise on the bottom line. That builds credibility, and you can hear it straight from the top. The CEO, Denise Polinones, is hammering this point home. She's not just celebrating the quarterly beat, she's framing it as part of their long-term financial algorithm. Now that's key language. It suggests this isn't a fluke, but the result of a deliberate, repeatable process. They're hitting their targets, growing that adjusted EPS by a very, very strong 12%, and they're proud of it. From management's point of view, the machine is working exactly as it was designed. Okay, the machine's humming, I get it. But Wall Street is seriously questioning the fuel source. Numbers and algorithms are great, but the market, it's a forward-looking beast. It doesn't care nearly as much about last quarter's beat as it cares about next year's growth. It is looking for one thing above all else: growth. Real, organic growth. And when it doesn't see it, it gets very, very nervous. So let's stop admiring the polished exterior for a minute and start pressure testing the structure. Let's unpack why the market gave these results such a cold shoulder. And this chart right here is the whole problem. This is the smoking gun. A year ago, the company was growing comparable sales. And remember, that's sales from stores open at least a year. It's pretty much the most important health metric for any retailer, at a decent 1.6% clip. This quarter, 0. Flat. Nada. That is a 160 basis point deceleration. The engine has completely stalled. When a retailer's organic growth flatlines like this, every single investor has to ask, is this just a temporary speed bump, or is it a sign of a much bigger, systemic problem? Is customer demand weakening? Are competitors eating their lunch? This is the giant red flag that overshadowed that entire earnings beat. So let's connect the dots here. The real issue is that the quality of that earnings beat is under suspicion. The flat comps, as we just saw, are the main culprit. But look a little deeper. The guidance raise, it was tiny. They only nudged up the low end of their full-year EPS forecast by 2 pennies. That's hardly a roaring vote of confidence. Management also started talking about macro headwinds, like government shutdowns, which, let's be honest, can sometimes sound like an excuse for softer consumer spending. And here's the most critical part, that 12% adjusted EPS growth wasn't fueled by selling more stuff. It was manufactured through better margins and by buying back their own stock. It was financial engineering, not business acceleration, and that is what spooked the market. Whoa, financial engineering is a dirty word. I call it disciplined capital management. And while I completely agree that the flat comps are a major concern, we cannot ignore that. You can't just dismiss the underlying financial strength of this company. Think about it. A house with a weak foundation will crumble in a storm, but a house with a strong foundation, that can be renovated, it can be expanded. So let's go down into the engine room and look at the actual mechanics of their financial performance. This is where the real heavy lifting is being done. Look, we have to circle back to this number because this is the bedrock of the entire bull argument. A 12% increase in adjusted earnings per share. In an environment where management is flagging macro volatility and consumer caution, delivering double-digit bottom-line growth is, well, it's impressive. This isn't just about cutting a few costs here and there. It means your gross margins are healthy, you're managing your administrative expenses efficiently, and you're using your cash flow intelligently to buy back shares, which juices the EPS for everyone else. This is the direct output of that financial algorithm the CEO was talking about. It's proof that the machine is in fact working. A working machine that's leaking oil all over the floor. You can't just show the pretty adjusted number without showing this one. This is the GAAP number, generally accepted accounting principles, the real number without all the convenient adjustments and add-backs. And it's down over 22% year over year. So tell me, how could a company be fundamentally strong if its actual, by-the-book profits are falling off a cliff? The gap between the adjusted story and the GAAP reality is massive. And whenever I see a gap that wide, it makes me question what exactly is being adjusted out and why. It feels like they're just papering over some very serious cracks. Forget the accounting debates for a second because cash doesn't lie. Cash is fact. Just look at the slide. They are building a financial fortress. Gross margin expanded by 50 basis points to over 51%. That is a high-quality, healthy margin. They generated $93 million in cash from their operations in a single quarter. And what did they do with that cash? They didn't squander it. They paid down $20 million in debt, making the balance sheet stronger. They returned $21 million to shareholders through buybacks. And after all that, they still maintained a very healthy 1.5 times net debt leverage ratio. This is the textbook definition of financial discipline. This is a company fortifying its position for the long haul. And all of that financial muscle is supporting a very specific, very focused business. They are experts in hair color and care. This isn't some general store trying to be everything to everyone. It's a specialist. Their whole identity is built around empowering customers, both the pros and the do-it-yourselfers. So to really understand those flat comps, we have to break down the performance of their core business segments and see what's happening under the hood. The devil's always in the details. And right away, this reveals a really fascinating split. It's truly a tale of two different businesses. First, look at Beauty Systems Group, or BSG. This is the part of the company that sells directly to salon professionals. Net sales were basically flat, down just a fraction. But look at the operating earnings, up a very strong 6.8%. They're squeezing more profit out of that professional channel. That's a huge sign of strength and pricing power. But look at the other side of the house. The Solly Beauty segment, the bigger business with the consumer-facing retail stores. Sales were up a tiny 1.2%, but their operating earnings declined by 2.5%. So in their biggest, most important business, profits are actually going down. That's a problem. That tells me the consumer is either buying less or Solly's having to discount more just to keep them coming in the door. Let's drill down even deeper inside that struggling Sally segment, because here's where their specialty really shines. The hair color category. This is their bread and butter. It grew a phenomenal 8%. This is their high-margin core competency, and it's firing on all cylinders. They're acquiring new color customers, and this is the engine that truly drives the business. But an engine needs more than one cylinder to run smoothly. The care category, we're talking shampoos, conditioners, the everyday stuff, was down 6%. That's a big drop. Management says customers are being selective in discretionary spending, but basic hair care is hardly a luxury good. This signals that customers are either trading down to cheaper drugstore brands or they're just pulling back entirely. The strength in color is masking a very real weakness in a foundational category. That's a fair point, absolutely. But management isn't just sitting on its hands watching the paint peel. They recognize the urgent need to reignite that top-line growth. They have a very clear blueprint for the future, a set of strategic initiatives designed to address these exact issues and build a more durable, faster-growing business. So let's take a look at that blueprint and see if it's actually realistic. So what's the plan? How are they going to fix this? Their blueprint rests on three core pillars. First, to deal with the margin pressure, they have their Fuel for Growth program. That's a major cost-saving and efficiency play. Second, to fix the tired retail experience and drive traffic, they've got Sally Ignited, a complete store refresh and modernization initiative. And third, to combat that weakness in the other categories, they're focused on brand expansion, bringing in new and exciting product lines to get people to put more in their basket. It's a comprehensive plan to shore up the entire structure at once. And you know what? We're already seeing proof that their modernization efforts are bearing fruit, at least in the digital space. Just look at these e-commerce numbers. Overall growth of 11%, and it now represents almost 12% of their total sales. But the real story is within that Sally segment, a 20% surge in online sales. This shows they are successfully connecting with the modern consumer online, both on their own site and through marketplaces. The digital refresh is gaining some serious traction. And the physical store refresh is showing real promise too. These Ignited stores are delivering. They're seeing a mid to high single-digit lift in new and returning customers, and people who shop there are spending more per visit. The proof of concept is there. The plan works. It works on a tiny, tiny scale. Let's be realistic here. They've refreshed 38 stores so far. Their target is about 80 by the end of the year. This is a company with over 4,400 locations. Refreshing less than 2% of your store fleet, no matter how great the results are, is a drop in the bucket. It is not going to be enough to move the needle on the company's overall flat sales anytime soon. The pace is just way too slow. But this is what pays for it all. This is the fuel from their Fuel for Growth program, $120 million in annualized savings. That is a massive war chest. This is the cash that allows them to invest in those Ignited stores, to pay down debt, to buy back stock, and to expand into new categories all at the same time. This isn't just random cost cutting, it's capital generation for reinvestment. It's the financial engine that powers all of their other strategic moves. So that brings us to the final verdict. We've seen the solid foundation of financial discipline and the strategic blueprint for what comes next. And we've also seen the very visible cracks in the growth story and all the questions about underlying customer demand. So is Sally Beauty a deep value opportunity, or is it a classic value trap? Let's lay it all out. The bull case is built on a foundation of pure financial strength. You've got 12% adjusted EPS growth, you've got expanding margins, you've got powerful cash flow being used to pay down debt and buy back stock. On top of that, you have absolute dominance in the high-margin hair color category and a clear, funded plan for the future. The bear case sees cracks everywhere you look. Flat comparable sales are a huge red flag. That 22% drop in GAAP earnings is alarming. The weakness in the core care category and the declining profits in their main Sally segment suggest the consumer is weakening. And ultimately, this growth story is being written by the accountants through cost-cutting, not by the merchants through more sales. And this brings us right back to the CEO's core message. The company is executing its stated financial algorithm. And right now, that algorithm is prioritizing profitability and shareholder returns over chasing top-line growth at any cost. In a volatile market, some would argue that's not just a viable strategy, it's the smart strategy. They are controlling what they can control, and they are delivering on those promises flawlessly. But at the end of the day, it all comes down to this one question. Financial discipline is commendable. A strong balance sheet is essential. Strategic initiatives are promising. But eventually, the market will demand proof that all these efforts can translate into the one currency it truly values: real, sustainable top-line growth. So, is that foundation strong enough to support a new phase of expansion? Or are the cracks in the growth story a warning that the entire structure is fundamentally compromised? That's the question investors have to answer for themselves, and that's what we'll be watching for right here at Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.